Hello and welcome. You're watching KYC. I'm Hersh Sayta. Today we're going to look at an interesting company from a perspective of stock price performance. It's been up 2x since the 2nd of May of this year. So it's given stellar returns to investors. Been a fabulous rally in the stock. What's leading to that rally is what I'd want to first off know. Second, we're talking about Sterlite Tech and therefore the optic fiber business is going to demerge and we're going to try and understand, or rather the optic fiber business is going to be the existing business of the company, and we're going to see a demerger of its global services business. Now, what does that demerger essentially lead to, and what are the opportunities now with regard to that demerger is what I'd want to explore. Is Starlink a potential client? That's going to be a big one if that is the case. So you want to understand whether that is actually the case or not. The other one is the opportunities. There's a BSNL contract as well as Bharatnet, which is a large investment which will come through. Both of those are big opportunities, but given this demerger, how much of an opportunity is that for a Sterlite Tech, and how much for the demerged company Sterlite Networks, which is yet to take shape and take form, right? So I'd want to know what the opportunity on each of those individually looks like. In terms of the optic fiber business, there has been a build-up in inventory in the US, which has led to some bit of tepidness with regard to the numbers over the last maybe year or so. Is that unwind actually happening? Are we seeing that unwind? How real is it? What could the impact of that unwind be, and what could the timing of that unwind be? And therefore, how does Sterlite Tech take opportunity from that? The other piece is with regard to India. The Capex cycle now likely at the fag end, so you might well see a slowdown in the India business. What does this lead to in terms of numbers, and how is Sterlite Tech placed to actually deal with that? There is also a huge debt which has been a drag on the numbers. We'll look at the numbers and I'll explain what the debt picture looks like. Now, in terms of that, what is the glide path with regard to debt going forward, and what is the impact of the debt falling on both EBITDA, maybe not on EBITDA, but more so on bottom line, which is on profit after tax. Now, the last one is this: growth and margin guidance in the optic fiber business. Found it difficult to actually find that kind of guidance. There's very generic guidance available. We'll try to quiz management on specific guidance if they have any. So all of that and more on today's KYC. Let me start off, as we always do, with what the company does and give you a quick snapshot of that. It's a global leader in the optical fiber and cables business. So that's what Sterlite Tech does. In terms of manufacturing, it has manufacturing facilities in 5 countries and sells to over 100 countries. The key focus area, of course, is telecom, but outside of that now, data centers could be the new lever. Digital networks is also the other lever. The recent demerger, of course, of the services business, we spoke about that, is now going to be demerged to STL Networks. How quickly does that demerger come through is the other question which I would have. In terms of product, and we'll break this down, you have the optical fiber cables, which is the core product. It's around 22% of the top line of the company. Optical fiber, which is raw glass fiber, is around 14% of the turnover. Copper or telecom cables is around 18% of the turnover, and optical interconnect, which is connectivity solutions, is around 12% of the turnover, has a slightly higher return on capital employed. So any positivity on that business will lead to a bit of an uptick with regard to ROC. And then there's a relatively smaller business called STL Digital, which is software, cloud, AI. It's got a smaller revenue size in comparison to some of the other core products which Sterlite Tech does. In terms of the business model, it manufactures, as I said, in 5 countries, including India, USA, China, Italy, and the like. You also have it selling not just domestically, but also internationally. 30% of the top line comes from international, and of course, it will have a whole plethora of clients. It's highly integrated in terms of raw material to finished goods, fairly integrated process, but copper could be the one big variant here or variable factor here. Of course, key competitors, among others, is a Himachal Futuristic, but also an HFCL, for example. And then there are lots of Chinese players, and global competition is quite high in this space. And that leads to a little bit of pricing pressure as well in bad times globally. So whenever there's a global slowdown in terms of Capex on the telecom front, you start to see the pricing start to chip away, which also impacts margins. So it's a cyclical kind of a commoditized kind of a business, largely because you have a lot of Chinese players and global players present. And therefore, any slowdown, cyclicality causes an impact with regard to numbers. Now, in terms of raw materials, the main raw material, of course, is copper, but you also have silicon. That's the other one. So the sourcing happens globally. It's LME linked, so and therefore highly commoditized. The price or availability risk is high. It's mitigated, of course, by local sourcing, and there's some active risk management which the company also does. There is some, of course, commodity risk which is very, very evident from the kind of raw material sourcing that happens. Pass-through, of course, is a challenge because that depends on what I just explained in terms of how the global competitive landscape is playing out and how pricing is playing out there. So it's all about scale in this business. If you can scale it well, then you're well placed with regard to the margin levers that you have are far greater in comparison to some of the other competitors. And Sterlite Tech is one of the top 3 players in this space and therefore has that advantage, but also has certain disadvantages. And for that, we have to look at the key metrics. And let's quickly break that one down. Let's understand first off, starting with the income statement. We'll thereafter look at the balance sheet, the cash flow, the return ratios, as we always do. Thereafter, we'll look at shareholding, street cred, valuations, and outlook. We'll cover all of those on KYC for Sterlite Tech. Let's start off with the income statement. And you'll have to take this with a little bit of pinch of salt, and I'll explain this. FY23 is the combined business number on the top line, so is FY24. FY25 of 3996 crore is just the optic fiber business. So if I were to take a comparable number, and that's why we've not given a CAGR number as you can see on your screen, but if you were just to take the comparable number FY24 versus FY25, it's a flat line with regard to the top line, right? So that's how the top line has evolved. Margins are largely 10%. So FY25 is now the new base with regard to where the numbers are concerned. I also want to highlight the one possible key positive here is the fact that your interest payments in FY25 was 241 crore. So that negative net loss or net loss of 123 crore, if I can call it, largely driven because of that interest cost being extremely significant. And you look at the interest coverage ratio, so which is the interest over EBITDA, that too is quite elevated because what you're seeing is the interest cost is so high, it's virtually covering 50-60% of the EBITDA, and which is not a healthy sign. But that's FY25. FY26 will show us a slightly different picture in that sense. And let's pull out those numbers and that will give us some perspective. The FY26 income statement or the Q1 FY26 income statement is largely driven by a 17% top line growth. The EBITDA has shot up substantially from 64 crore, it's up to 132 crore. Margins have inched up as well. And what you're seeing on profitability is also quite strong. It's a 10 crore profit. So from a loss of 120, it's come to a 10 crore profit. The question will obviously be how sustainable. You don't want to look at those QOQ and YOY numbers with regard to profit because the erstwhile number is actually a loss. And therefore, you want to remove those. In terms of the margin trajectory as well, let's pull that up. There you go. So you're looking at margins which were sub 13% in FY22. They fell to 10% in FY24, FY25 and have now rebounded towards the 13% mark. The question is, there is an aspiration to increase margins. The question is, how much can they do that? How much bandwidth and how many levers do they have to actually increase the margins and therefore increase likely profitability? We've given this a neutral because it's a fast evolving environment at this point, both on the top line as well as on the margin number. You're seeing so much variability, it's difficult to quantify exactly where it will go. The other question also is that how sustainable and what kind of a sustainable number can we arrive at where the margins are concerned. So all of those questions we'll try to get answered and get a better perspective on that. But let's quickly move to the balance sheet. And you're looking at an equity raise which happened last year of around 1,000 crore, which is what has led to the bump up in the equity capital, which you can see on the top line. Other equity book value also there. What you're also seeing is a borrowing number of around 1,800 crore even now. That is likely to go down, and that is significant given that the company has a market cap of around 6,000 crore. The debt to equity is nearly 1:1. So not looking pretty even from that perspective. But we've given this a neutral given the fact that there is a thought process to bring this down sharply. There's an intention to do that. How quickly, how sharply is of course the question. Therefore, again, difficult to rate. We've given this a neutral. Cash flow. Now, very quickly on the cash flow, you look at cash flow to EBITDA. FY23, there was inventory build up, there was receivables build up, all of that building up has led to that kind of number. So there's variability on this as well. How stable can the cash flows be going forward will again be the question. But largely, last couple of years has been okay. Again, the payables spiked in FY25. We saw receivables spike as well. Or rather, payables fell in FY25, receivables spike as well. All of those adversely impacted the operating cash flow in FY25. So that's how it's played out. Your ROE numbers not looking healthy either. So your ROE numbers have been volatile. Can there be more stability is the question, but clearly that one's also a thumbs down. When you're looking at shareholding, now shareholding has been above the 50% threshold. They've diluted a little bit and brought it down to 44% now, and that is only because of the QIP that they've done. So really no selling per se from the promoter group, but what you want to see is more stability, lesser dilution happening. So some color around that will help as to how funding is happening with regard to the debt which they are planning to service and how quickly can they service that. Now let's look at street cred. This has been fabulous and this has been very interesting. You look at the 1 month stock price performance up 19%. The 2 month stock price performance, it's a two bagger. 6 months is up 21%. Year to date up just 8.5%. And the 1 year stock price is actually down 15% and 5 years is also down 15%. So you've given this an absolute neutral. It's given the quantum of variability with regard to stock price performance. But of course, recently, the stock price has done very well, whereas over the longer term, it's been quite a dampener in terms of returns for shareholders. Now, let's look at valuations. This is a very tricky one. Frankly, viewers, all these metrics have been extremely tricky to kind of deal with. So want to keep it out there, put it out there. In terms of current EBITDA, it's at 416 crore. We discussed this. EBITDA as per Nuvama estimates for FY26, I'm talking about now, 694 crore. The enterprise value currently sits at around 7,500 crore. Mind you, this is basically price to EV broadly is how it is dealt with in terms of the valuation. EV to EBITDA is what they deal with in terms of the valuation. So at current, EV to EBITDA is around 18 times. 1 year forward is around 11 times. And if I were to roll this forward to 2 years at a 15% margin, then you're roughly trading at sub 9 times EV to EBITDA. Question will only be, is that doable? Is that sustainable? Can the top line grow at the rate at which we're penciling in terms of our estimates? But broadly, that's the thought process. Let's look at the outlook. There's no numerical PAT or revenue guidance which has been given by management. The growth levers, North America, India demand, capacity utilization going up, data centers and AI, all of that is likely to drive demand going forward. But how much can the top line grow by is really the key question. Margins, EBITDA is likely to improve, again, by how much and what is the aspiration? How quickly do we achieve that is the question. Geographic risks, US and EU tariffs is a big risk on the books. Want to know as to how will that impact the numbers overall. And profitability, well, they aim to turn PAT profitable. They have done that in Q1 FY26. Sustainability of that will really be the question. Very, very difficult to tackle all of this. No absolute clear guidance, and maybe we'll get that as we speak with Ankit Agarwal, who's the Managing Director at Sterlite Tech, who's going to join us in just a minute. Let's wrap up on the ratings. Now, probably the only company where we found it very tough to put out a rating, but we've done that nonetheless, and that's how it all stacks up. Overall, it gets no thumbs up. That's the one key negative. 3.5 on 8 And mind you, viewers, we've been cautious about this. So I want to put it out there that we've been super cautious with regard to our rating on this one. But it's an interesting one. And therefore, let's go across to Ankit Agarwal, Managing Director, Sterlite Tech, joining us. Ankit, great having you. Let me first start off with what the levers are with regard to growth. You've been at around the 4,000 crore top line number last couple of years. Do you start to see growth come back significantly this year? And I won't talk order book, I'll just talk execution. Give us that perspective.
Yeah, thank you, Hersh, for having me on the show. So I think definitely in terms of the levers that you touched on, the primary one that we look at is how do we improve our cable demand. And as we've been guiding, we want to take this from about 45-50% utilization towards 70% plus utilization. We see that happening as our order book continues to grow and we execute on that. And probably towards Q3, Q4 of this year, we'll move in that direction. If you look at our own numbers from 2 to 3 years ago, when we have broadly run our factories at 70% utilization, we moved towards that 18 to 20% EBITDA margin from currently around 13%, 13-14% margin currently. So that's really what we are focusing on. We've also been working towards improving our cost structure over the last 18 months, and you see that now in terms of our numbers as well. So I think this is the primary focus. On top of this, we are seeing two other areas. One is our connectivity, which we are clear that we want to build in terms of cable and connectivity, improving our attach rate. Currently, that's broadly around 20-22%, and we want to see how we can grow that. And the last part is in terms of data centers. That's a very important growth segment for us. We've been looking at how do we build our portfolio, and recently we've launched our portfolio as well. We're already in conversations with various data center players in India. And as we are all aware, data center capacity in India is expected to go from about 1 megawatt to almost 3 megawatts, 1 gigawatt to about 3 gigawatts between now and 2030. So that's basically the focus area for us as a company.
Okay, so Ankit, point taken. Likely the stock price rally is because of that guidance that you're going to try and hit 70% capacity utilization closer to Q3 onwards. How likely is that? What are the levers of you getting there? Is it the robust order book that gives you confidence? Is it the demand pipeline that's giving you confidence? Is it the pricing, which also you are largely seeing to be okay? Is that what's giving you confidence? Give us all of that.
Yeah, I think, see, our focused markets continue to be US, Europe, and India. And across all three, we have good reasons to be positive. As we've been sharing, we had about 18 months period where actually US demand was very strong, the deployment was very strong, but there was excess inventory in across the system. A lot of that has now got reduced and depleted. So we do see fresh demand coming from our customers, particularly in the US. And this is also a positive sign for us. We've also been early to the business in terms of setting up our facilities in North America. And now we have a state-of-the-art factory which can serve the customers locally. So I think we're well set up for that. In Europe as well, we have a state-of-the-art manufacturing in Italy. And we're well set up to serve the markets, particularly UK, Italy, Germany, which are very fast-growing markets in the Europe segment. And India as well, while we've seen the market being steady, we do expect some growth in India on the back of Bharatnet Phase 3, where some of the projects have been awarded and balance will also get awarded in the coming months.
Right. So, and US, do you see that inventory unwind happening, Ankit, at all? And how quickly can we see that happen? Because that will be one key lever. Anything with regard to geopolitics affecting your business? I know you have capacities everywhere, and therefore unlikely that it will impact your business, but does it at all? Give us that perspective.
Yeah, I think on the first point, as I said, we have seen that inventory substantially reduce. And if you look at our peers as well in the US, they're also seeing increased demand, both from the telecom segment as well as from the data center segment. Our own view is that the US itself will continue a healthy deployment of fiber over the next 4 to 5 years. So that's something that we're quite excited about, and we want to increase our market share in the US. In terms of our attach rate as well, we want to grow our business, particularly in the US as well for this. In terms of the geopolitical environments, I think it's positive that we have a free trade agreement signed with the UK. So I think to that extent, our business continues to be healthy in the UK. In Europe as well, we are well set up with majority of our supply into Europe coming from our factory in Italy. So we are well, protected out there. And similarly, in the US as well, we have a state-of-the-art factory there, which serves the US requirement. And to some extent, we manufacture from India and supply to the US. To that extent, we are looking at what could be the possible tariffs that get announced, and we're looking at various measures to mitigate that.
Now, let me understand India. You have BSNL, you have Bharatnet. How much of these opportunities does Sterlite Tech take? How much of it is Sterlite Networks opportunity? How do you break up these opportunities? How should one look at the 2,631 crore order which you already have between both these entities? Give us that breakdown.
Yeah, so at a macro level, important to appreciate that India is less than 5% of the world optical market. So while we're excited about the growth, really from a major impact to our bottom line, it really comes back to Europe and US markets. India is important for us. It's our home market, and we're excited to connect every village in India with optical fiber. STL, the networks business, has taken up a project in Jammu Kashmir, which is a combination of Capex deployment for 3 years and then maintenance for 10 years. So that's largely the project that's been taken up by that business, which is under the brand Invenia. In terms of the optical fiber cables and connectivity, that's typically in that range of 5 to 7% of the value of the Capex. It's what ultimately would come to Sterlite Technologies. But equally, we have given our MAF, which is our right to partner with various other bidders who have currently won some of the projects, and there are other bids which I mentioned are on the pipeline.
Sure.
So basically, our focus in Sterlite Technologies will be the supply of our products, both to Invenia, which will be at arm's length, as well as to other companies as well.
Right. Ankit, I have 3 minutes and I have 3 quick questions. Starlink, is it a potential client?
Starlink will be interesting. I think it's very interesting where I think the technology will be useful for, say, remote and rural applications. I think the cost structure, the latency, and the speeds, they will struggle in in your main cities, etc. But certainly, if there is an opportunity to partner with them on some of the connectivity requirements from the satellite, from the link at the home into the house, I think those are areas we could look to partner with them or the other satellite providers. As I said earlier, our main focus is on the fiber and the fiber connectivity. And for that, the primary requirements are around 5G, fiber to the home, and now increasingly data center requirements.
Got it. Ankit, as you go from 45-50% capacity utilization to 70%, where does your top line go? FY26, give us a perspective. FY27, give us a quick perspective.
I won't be able to give any quick perspective. I can only share that we do see that our margins will improve as our utilizations improve quarter and quarter. And I think we're just really focused on our large clients in our global markets, looking to secure long-term contracts with them and really look to support them with both our cable and connectivity as a combined solution.
Okay, all right. I take your point. Ankit, debt reduction, how much and how quickly?
So we've guided that already, that it is important for us to reduce our debt. I'm happy to share that we've done majority of our Capex over the last several years. So from a cash flow perspective, whatever cash we generate, a good portion of that will be utilized to reduce our debt. And our target net debt to EBITDA is to bring it down further to 2 times by end of the year. So which we believe is a healthy position to achieve, and we're confident of that.
Okay, thank you so much, Ankit, for coming and speaking with us. Out of time on this edition of the show. Appreciate all the replies that we've got. So thanks for coming and speaking with us. Viewers, completely out of time on this edition of KYC. Thanks so much for tuning in. Stay tuned to NDTV Profit. More action just on the other side.